Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, December 19th, 5:44 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup daily market insight video. Market state in a short-term downtrend as of yesterday, with the big collapse through key support levels on the S&P 500 in the wake of the hawkish cut, 25 basis point cut in interest rates, but a reduction in 2025 of the projected number of cuts, and some negative or confusing language from Powell regarding inflation and employment. Market didn't like it. Didn't hated it yesterday. Didn't like it much more today. Fake gap up at the open failed badly, and reversed into a three waves down trend down day. No change to the trend gauge. The damage was done yesterday. We slid market leaders to neutral with the red sub arrow. Short-term downtrend for all the major indexes went into effect yesterday. Clear break of the 21-day moving average. Medium term, we're yellow. That might be being generous. We've got the red sub arrow there. The NASDAQ 100 remains the only one of the indexes above the 50-day moving average as it battles with its 21-day moving average. But keep in mind, the market never gets into serious trouble unless all these indexes start to break their long-term 200-day moving average. That's why, right? We invest across 3 time frames and in market leaders. And basically all it means is the market is telling us that the wind is no longer at our back. It's at best a crosswind, working to be a headwind. And we take the clues from the market. We're not stubborn. We have no ego. We respect price. And price told us to follow our program, and that is to lighten up when you start breaking short-term and or intermediate term levels, and also stops hit on our leading stocks. A lot of them still holding up pretty well. We'll take a look at some of the charts there, and that's what we'll be on the lookout for as we progress. What's showing relative strength? These types of markets tend to separate the pretenders from the contenders, and some will stick, some will go by the wayside. We discussed 6 of each in today's podcast. Make sure you check that out. We also did a deep dive into the technicals of the market. Podcast doesn't get as many views, maybe because it's longer, but the whole team did a great contribution to this one. So be sure and check that out. We did it today because I'll be traveling tomorrow, and it's out there on YouTube now. So what happened today? As I said, nice gap up at the open. That lasted not very long at all. We put in the highs pretty quickly and reversed to a 3 waves down trend day. Some decent action in the leaders and the big 8. You can see the 21 over 21 list, 13 up, 7 down. One was neutral. Up an average of 1/3%. The big 8 up an average of 0.4%. The RG8 to the downside by 1/3. Reversals across the board in the major indexes. The S&P, like I said, gapped up 0.75%. Close near the lows of the day. You'll see the chart here momentarily. Global 60/40 down just a bit. Our flagship portfolio, GROTECTION, slightly positive on the day. Situation like this where we're battling along the 50-day moving average on the S&P, we target our beta to be around 1. We're a little bit below that now. That's just fine. Basically, we are in the wait and see. Are the indexes going to for one thing, we're extremely oversold across the board. There have been, as we've been talking about, a few stocks holding the indexes up in leaders. Rough day yesterday, but a lot of them still holding the 21 and even the 8-day moving average. Those are the standouts, and that's what we'll be keeping an eye on. So let's start off with I've got the NASDAQ 100 up. Let's take a look at this. You can see the break of the 21 yesterday, gapped above it, faded above the 50-day, below the 21-day, the best looking of the indexes relative to its moving averages. Now, S&P 500 broke the 21 yesterday, 21 has rolled over now, gapped above the 50-day moving average at the open, actually made a lower low today. Take a look at a 5-minute chart here. It's pretty clear what you see. The gap up, that topped within the first 10 minutes. And then one wave down, a little bit of a bounce, two waves down, a little bit of a bounce, three waves down, close at the lows, lower highs each time we tried to bounce, lower lows each time we pulled back from those bounces. That is a pretty much standard all day, three waves down, trend down day. Not what you wanted to see, but not surprising. We're in a big support area here around this 58.50 to 58.80-ish level. You can see that was the resistance before the election breakout. That was the support that held when we pulled back after the election and made new highs, and now down right at that level again this week. The 100-day moving average is just a bit below where we are there on the S&P. Dow Jones Industrial Average, yikes. Uh, Not much else to say about that picture. Well below the 50-day moving average. Let's look at the equal weight S&P. Looks a lot like the Dow. Um, Man, the warning, we were actually, kind of optimistic going into the Fed because of how oversold we were, but oversold can certainly get more oversold. There was a big divergence here. All these value stocks selling off badly and then selling off even more after the Fed. Don't ever predict what the market's going to do. Just be prepared for what you see. Let's go to the mid cap 400. Looks a lot like the RSP big break of the 50-day moving average. These are, just a couple of percent away now from the 200-day moving average, 2% in this case. And finally, the Russell 2000 small caps also looks terrible, 3% away from its 200-day moving average, big slice of the 50-day as well. So those are the major indexes. Let's go to interasset correlation. We'll start off with the VIX, which had a massive spike yesterday. Also closed at the highs of the day as we sold off. That makes sense. But it was down about 13% on the day from the prior day's close. How about the US dollar? In times of fear, market money flows into the dollar. And that high that we were looking at the dollar 3 weeks ago, 4 weeks ago, when it pulled back, the market rallied. Well, the dollar's rallying again and the market is reversing. So that inverse correlation firmly intact there. Higher highs today on the dollar. Precious metals, gold broke down yesterday, tight range today. Gold stocks breaking the 200-day moving average, making a lower low. Silver breaking the 200-day moving average as well. Bitcoin weakness today broke in the 21-day moving average for the first time since it broke out of this big flat base back at the beginning of November. So keep an eye on Bitcoin versus the 21-day moving average. Let's flip the bonds now. Broad bond index. Prices down yesterday, meaning yields up, continuing the same today, closing mid-range. Broad bond index down 1/3%. TLT, the long bond, down 1.5%. Awful. 87.34. So not quite at the lows that we set back in April, but right near that level now. And if the bond prices are down, the yields are going to be up. There's a gap out of this kind of nice looking cup and handle base here, which would be fine if it was a stock, not so fine when it's the long bond yields. TNX, the 10-year, same situation. That's our interasset correlation. Let's go to the tail of the tape. From a technical analysis standpoint, all the stochastics nothing's in our favor except this percent of stocks below the 5-day that is buried to the downside, screaming for a bounce. When will we get the bounce? We don't predict. We kind of thought we'd got it yesterday. After the Fed, the complete opposite was true. Don't predict, have expectations, but prepare for any outcome. Fear and greed now in the extreme fear level. From a contrarian standpoint, the AAII and NAIM improved today as investment managers got less invested, and bulls also pulled back on AAII. Some news: debt ceiling negotiations continue. Friday morning before the open, we have PCE inflation data, and inflation data, which was not critical for a while, now back into the view in its importance again after the Fed yesterday. So we'll see what the reaction is before the market on that inflation data. He's coming into today. So the S&P is trapped between the 50-day and the 100-day, stayed below the 50-day, above the 100-day. The NASDAQ 100 is trapped below the 21-day to the upside and the 50-day to the downside, below the resistance area, above the support area. Continued selling, absolutely, with a gap up and a failure into three waves down. Day count from day one to day two. Third day down below the 8-day moving average. Second day below the 21. Our expectations are now to be defensive as long as we're below the 21-day moving average on the S&P 500 and NASDAQ 100. I mentioned the three waves down, sectors. Oh, also the ATR and the S&P is going to be drastically expanding. This is a 21-day ATR that we use. It's below one, which is good, but it's rising quickly. And it'll certainly, with the 21-day coming off, the 21st day coming off tomorrow, and adding a 1+ day on top of the 3-day, the 3% range on Thursday. This is going to be climbing very quickly. Strong sectors today: defense, financials, tech, just barely, and utilities. To the downside, oils, ITB, builders got just destroyed. Rising interest rates and bad housing data, and semiconductors pulling back too. Portfolio changes. Trimmed UPRO with our break below the 50-day moving average back to our target exposure of about a 0.5 for the S&P 500 portion of the portfolio. We also trimmed some Bitcoin, wrapped a 40+% gain up on the break of the 21, and trimmed some bros as well. Our adjusted beta below 1 now, 0.92. Balance at risk to the downside, about 3.4%. So 3 trims, taking us below 1. Bottom line on the day: post-FOMC gap up reversed miserably and became a trend, a 3 waves down trend day. Same keys tomorrow as today: S&P against its support and resistance, NASDAQ 100 against its support and resistance. And how about the surviving leaders? We're going to take a look at some charts that are holding up well, including things we still have a partial holdings in the portfolio. Are they going to continue to survive tomorrow? Let's take a look at that list. And they're from the 2121, as always. So A-Lab, we'll start with this. Now, the best thing you can say about a stock is that if you look at the chart now, you really, and you can't tell what happened yesterday in the major indexes, then for darn sure that stock is holding up well and leading. Extra points if it's above the 21, double plus extra points. That's a 1984 George Orwell reference, double plus extra points. If you're above the 8-day moving average, and A-Lab is, and we still have a partial position in this. IBIT, as I said, we trimmed to a partial position on the break of the 21 today. Reddit really doesn't look like a big down move happened yesterday, holding the 21, sitting right there on the 8. Still have a partial in this. Bros, we trimmed a little bit about this. This actually started correcting about a week and a half ago, along with most of the restaurant stocks. Sitting below the 8, but above the 21, partial position in this. Tesla, 2 days of a pullback, looks normal in context of the run. Those 2 days of a pullback, kind of the candles pretty much look like the indexes did, but it's still sitting above the 8-day moving average, and that's a testament to how strong it was during that run up. Google, pullback, actually finished positive barely today, pulling back from that 200 level, still looking fine, sitting on the 8-day moving average, and the last holding that we have, AVGO. 3 days of a pullback after 2 huge days up. We're down a little bit on this partial position. We'll hold it versus the 8-day moving average, which is that purple line there. What other stocks acted well today? Well, there's a couple that really stood out to us. Let's sort this 2121 list by price up and some ones that we don't own. Palantir, this This is probably the best looking chart in the market, certainly from growth stocks that you will find out there. Up 3.8% today, back above the 21-day moving average and above average volume. Marvell, we stopped on this yesterday. Inside day today on above average volume, still holding the 21. So good stuff there. Something that we don't own and isn't in the 21 over 21, but I imagine it will be next week is Ollie's. Great chart making higher highs after breaking out of a base, nice flat base on its earnings report. And GEV looking like a false breakdown here, but just bounced at the 50-day moving average. Definite relative strength today. This is a nice tight 6-week formation. If the market rights itself, this will be one that's at the top of our list. Massive growth on the EPS from the EPS perspective there, as you can see. And what else jumped out today? That's really about it that I want to bring to your attention in this video. So I'll wrap it. Remember, we always like to hear from you. The email's don@revereasset.com. The phone's 855 Real Wealth. That's 855-732-5932. If you're interested in becoming a client, my partner Dan Stewart, dan@revereasset.com, will answer all your questions and begin the onboarding process. We have had a massive flood of people joining Revere over the last couple of months, and we appreciate each and every one of you. And they like the transparency. We talk about everything we do to the portfolio every night. Talk about our stance on the market, talk about how aggressive or defensive we're getting. And we've got that dual mandate of growing assets during uptrends. But if things start getting weak, we start lightening up. We know when the wind's at our back. We know when it's in our face. It's in a transition right now. Side wind at best. A few leaders holding up, but breaking the short-term and intermediate-term moving averages. There's a decent amount of space on the S&P 500 down to the 200-day moving average, 6.2%. Much less for mid caps and small caps, and the RSP, a little bit more for the NASDAQ 100. But until you get down here, there's no significant fear in the market. What we'll do is we'll lighten up and we'll wait now. Bob and weave with the market, trade lightly because when emotion is in the market, the averages are just lines on a chart for reference when emotion is in the market. So keep it close to the vest. And with that, I'll wrap it for Thursday, December 19th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.